Q4 and annual results FY20 press conference. We will be starting shortly. Hello, everyone, and thank you for joining us today for HCL Technologies Q4 and annual results FY20. We hope that you and your families are safe and in good health. I'm Neha Anand, and I would be your host for today. Before we begin the conference, I would like to share some key instructions with you all. During the conference today, all attendees will be in listen-only mode. There will be a Q&A session at the end where you can ask your questions. In case you drop out, please rejoin us using the same invite link. Please rejoin us using the same invite link. If you experience any technical issues, you can message us using the Q&A panel. Today, we have with us HCL Technologies President and Chief Executive Officer, Mr. C. Vijayakumar, Chief Financial Officer, Mr. Prateek Aggarwal, and Chief Human Resources Officer, Mr. Apparao VV. I would now like to hand over to Mr. C. Vijayakumar. CVK, over to you.
Yeah. Thank you, Neha. Good morning to all of you. I hope all of you and your loved ones are safe and well. At a time when we have drifted apart from each other, technology has become a great enabler in keeping us connected. While there are many who are coming to grip with their losses caused by this crisis, I want to thank the frontline healthcare and essential services personnel for their selfless service to humanity in this difficult hour. They are the true heroes of our times. At HCL, we are playing our part in mitigating the impact of this crisis. We took a very pragmatic approach by focusing on initiatives that brought immediate and meaningful impact on the ground, like setting up an integrated pandemic command center in Noida and Chennai, setting up a state-of-the-art disaster management data analytics center for Tamil Nadu government, provisioning of ventilators, provisioning of PPEs for healthcare workers, distributing tens of thousands of meals and dry rations every day for families in need, enabling employee contributions with a HCL match to select organizations, and lastly, providing food for stray animals who too cannot be neglected in this crisis. All through, our most important priority has been our employees and their families. The first human-to-human COVID-19 transmission outside China started on the 25th of January, and we at HCL kicked off our extensive response and pandemic planning and business continuity measures within 24 hours of that. That was on the 26th of January. This early response, combined with meticulous execution and an effective governance, ensured that we were able to achieve stable operations very early on in this crisis. Today, more than 96% of our employees are working from home, and about 2.5% of our employees are working from our client locations or from our own offices globally. In fact, this week, that number has even gone up, given that there is some relaxation in some geographies on our ability to get people to work from offices. During this time, we've created very innovative digital platforms to engage with our employees. We've created social engagements, recreational opportunities. We have also taken a very, very strong role in ensuring the mental health and providing all the medical support to our employees. Our global COVID-19 helpline, enabled in partnership with HCL Healthcare and manned by doctors and nurses, is perhaps the only one of its kind in the industry. I want to thank the 150,000 HCLites who have worked relentlessly over the last few months and have invested tremendous efforts in keeping our internal operations and our client operations running. As you know, several of our clients are in mission critical sectors and they're in the front lines of fighting the virus. We've enabled more than 3.5 million professionals across the globe to work from home and thereby keeping the key wheels of the global economy running. Our clients have also asked us for rapid scale up of their user facing applications and providing additional capacity. For example, our life sciences and healthcare business, we are being asked to scale clinical trial environments, build IT infrastructure for enabling expanded capacity for the facilities treating COVID-19 patients, remote approval of drugs by healthcare providers, and customers are asking for robust BCP deployment for critical hospital management applications. We also did a client satisfaction survey to measure the effectiveness of our COVID response. And our client satisfaction survey showed 99% of the respondents agreed that our business continuity measures were very effective or effective. And we surveyed over 3,600 client respondents out of 600 accounts. So it was a very, very good outcome that almost everybody found our response very effective, very early, very proactive. We were quite humbled to hear that feedback. Equally humbled by our employee feedback on the company's effort towards supporting them, their well-being, and ensuring a lot of proactive direction, communication, engagement. In an internal survey, 90% of the HCLites rated us internally as our efforts were very satisfying for our employees. Going forward, we continue to remain very committed to three priority agendas: employee well-being, client support, and community support. With that commitment, I will share some highlights of our Q4 and fiscal 20 numbers. Let me start with the quarterly performance. Because we identified the risk presented by COVID much early and we planned and executed very well, and that ensured that the impact due to pandemic was relatively small in the last quarter. In Q4, we posted a strong constant currency growth of 0.8% sequentially, largely fueled by our Mode 2 offerings, which is digital, cloud, cybersecurity, and Internet of Things. Our Mode 2 services grew 7.1% quarter on quarter, which has been an amazing performance. We also delivered an EBIT of 20.9% this quarter, which has been the highest since March 2015. We signed about 14 transformational deals this quarter. We also had record bookings in Q4 for the fiscal FY20, in spite of a slowdown towards the last few days of the quarter. Coming to FY20 performance, from a full year perspective, FY20 growth stands at 16.7% year on year in constant currency. This has been a landmark year for us. We witnessed our highest growth in recent years and an industry-leading performance for the fourth consecutive year. We met our EBIT margin guidance for the fiscal, closing the year at 19.6%, which is above our guided range. Combined Mode 2 and Mode 3 revenues stood at 33% for the fiscal 20, growing from 28.4% in fiscal 19. We signed 53 transformational deals in fiscal 20. We also witnessed a very strong client addition. We added 5 more customers to our $100 million category, which is the highest revenue category that we report. Just talking about our segments, verticals, and geographies, IT and business services grew 12.7% year on year on constant currency, fueled by our infrastructure and DPO services. Our Fluid Workplace service, which is an offering in the digital workplace service, which enables flexible working infrastructure to employees of global enterprises, was a major contributor of this growth. I'm sure all of you know, we saw this trend intensifying in March and continuing as we speak. Our engineering and R&D services posted a robust 12.8% year-on-year constant currency growth, and our products and platform business grew 60.5% year-on-year in constant currency. From a vertical perspective, on a year-on-year basis, 6 out of our 7 verticals have posted double-digit growth. Technology and services segment posted a very strong growth of 36%. However, the reclassification of the IBM products acquisition has brought it to a single-digit growth when you do a like-to-like comparison. Apart from technology vertical, the growth was led by manufacturing at 34%, telecom and media at 22%, retail and CPG at 21%, energy and utilities and public services at 20.5%, life sciences and healthcare at 13%, financial services at 11%. All of these are year on year in constant currency. In terms of geographies, Americas grew 15.8%, Europe grew 18.3%, and rest of the world grew 18.2% year on year, all in constant currency. I will now talk about the demand environment that we are seeing in 2 parts. I'll start with the short term, and then I will talk to you about the medium and long term. Looking ahead into FY21, we did a detailed portfolio analysis, very granularly looking at our service offerings and revenue from our clients. We are constantly in discussion with our customers and understand how this crisis is impacting them and how we can be of help. And that has been the most overwhelming conversation. We've reached out not to kind of talk about our revenues and how are we going to kind of fare, but the conversations have been, how can we help you? And our customers have highly appreciated our approach. On the demand side, we've largely identified the impact, though some portions of it are still being iterated. The demand side issues are like volume-based billing impact, where the customers have shut down some plants and have put some employees on furloughs. There is some volume-based billing impact. There is some deferral of discretionary spend. Some new project decision making is slowing down, and some price discounts and maybe payment term extensions. These are the type of issues we are seeing on the demand side. In terms of the industries in our portfolio that are most impacted, it's mostly around industrial, auto, aero, entertainment, and non-grocery retail are the segments which we see more impact. But there are several verticals where we see the impact is very low. Financial services, telecom, and professional services, we see low impact. And also our portfolio has certain insulated industry segments like life sciences and technology services are fairly insulated, and we are seeing some robust demand there. So in essence, we are seeing both kind of impacts, pockets of good demand in weak verticals, as much as weak demand in perceived to be strong verticals. Given our portfolio mix and strong relevant propositions that we have, we do not see this pandemic influencing our multi-year engagements beyond the short term. Our efforts of building strong relationship with our clients, who most of them are Fortune 500 or Global 2000 brands, with very strong and sustainable business model, gives us that confidence that in the long term, they're intact, but in the short term, there could be some challenges. So our commitment to clients at this time is to invest in these relationships in the short term, and we will be rewarded in the medium and long term. In summary, we see some clear impact to our growth story in the short term as we help our clients to deal with this downturn. However, we are not in a position to quantify it at this time since there are many moving parts. And there are many other initiatives that we have taken up from a cost control perspective. There are many low-hanging fruits in terms of reduction in travel, marketing, third-party spend, and other operational expenses. Uh, so while we are doing all this, we are absolutely committed to keep our employee morale high. There will be no COVID-related redundancies. Our employees continue to be our most important stakeholders, and there will be no compromise on our employee experience. So, with that short-term commentary, I do think the future looks quite bright. Medium and long-term prospects of a technology business like us, with a very balanced portfolio, is going to help us grow and emerge stronger in the medium and long term. We are also seeing a number of trends playing out. For example, digital transformation, which a lot of customers have embarked on in the last few years, is only going to get accelerated. What was expected to get completed in 2 to 3 years are now being planned to be done much faster. Though it's early stage of planning, some sectors like retail, auto, travel, hospitality will redefine their customer engagement by a zero touch and by leveraging every possible technology, conversational AI, analytics, digital engagements, all kind of technologies will come into play to enable a zero touch kind of interaction. There are momentum sectors like life sciences and healthcare, which will continue to see a strong demand. We believe the hospitals of the future will be looking very different. They may just have operating theaters and ICUs, and everything else will be remote. So all this will need huge investments from a healthcare or hospital infrastructure perspective, which is a great opportunity for providers like us. A few more opportunities that we see in terms of product and professional services led carve-outs, captive carve-outs, and also a significant spike in demand for managed services on cloud platforms to avoid capex and spend on opex. We see the market, as we see the market, we believe service providers who will benefit in the medium term will be the ones like us with very strong capabilities in workplace transformation, network and security transformation, strong scale digital capabilities, cloud migration capabilities, and especially those with strong partnership with hyperscale providers. Our added strength comes from our products and platforms portfolio that is trending well in line with our business case, along with some strong propositions for tomorrow, like digital collaboration, security, e-commerce, which are more critical now than ever. Uh, in terms of the working model and the future operating model, while it is too early to completely predict and redefine what the future operating model will look like, we do recognize that this will change across the globe as geographies and communities return to some kind of normalcy. We do see return to offices. We believe this return needs to be very well calibrated. We do not foresee more than 10% of our employees coming into offices by end of this quarter, and we will keep evaluating it on a weekly basis and see how to react to the situation. Uh, we are seeing significant increase in productivity in the work from home operating model. However, this is under a lockdown scenario. We need to evaluate how this will work out in a non-lockdown scenario. And our customers have been extremely supportive of work from home in this crisis situation. But in a normal situation, how will the privacy and security aspects play out is something we have to see. So I think it's going to take some time to really determine what the long-term operating model will be. But directionally, I see in 12 to 18 months, 50% of our employees would work from home and 50% will work from offices. And this will be in some kind of rotation model where everybody gets to come to office for some time and everybody gets to work from home sometime. That's how the industry would evolve and the working models would evolve. Uh, I want to summarize today's circumstances are quite unique, but we are confident that our employees' capabilities, our business mix, our deep rooted client relationships, and a strong balance sheet and financial strength will see us through this phase. And I do believe we are getting into a crisis phase from a position of strength. We've had 4 years of industry leading growth. We have stable profitability. Our new services and IP-led investments are all paying rich dividends. So we're going to emerge very strong, stronger than ever from this crisis. With that, I'll hand it over to Pratik for some more details on the financials.
So, hello everybody, and I hope all of you are safe and keeping well, and all your loved ones too. Uh, that was a long, so much business from CVK. So, let's sort of have a little bit of a break. Let's talk cricket, right? I'm always reminded of my friends in the media that you said something about sixers and chokkas in some previous press conferences. So let me sort of anticipate their questions and do justice to them. This certainly doesn't feel like cricket, right? This time of crisis and gloom and doom. But, when I go back to my earlier years, when you did not play with the cricket ball, you played with the tennis ball, right? And what does the tennis ball do? It gives you a lot of bounces. So think of this time like playing cricket with a tennis ball. So with that little bit of interlude, let's get back to business and the great results that we have here to share with you today. HCL ended the year, these are the annual results, with rupees 70,000 crores plus of turnover and net income profit after tax of 11,000 plus crores. Those are very healthy numbers. The revenue has grown by more than 10,000 crores on a year-on-year basis. In constant currency, it's a growth of 16.7%, and so is it in rupee terms, it's a 17% growth year-on-year. Even the quarter four growth is 13.5% in constant currency terms. And the best part about this growth is, of course, the organic growth. Out of the total 16.7 for the year, 10.7, which is pretty much the largest part, has come from organic growth. And as you may remember, it started right off from the very first quarter of the year. And even in the quarter, the current quarter Q4, it was 6% year-on-year growth. And that was just the top line, which was well within the guided range, as you know. The guided range was 16.5 to 17%. But remember, at the beginning of the year, it was only 14 to 16%. So from a level of 14 to 16, finally delivering 16.7% is extremely gratifying and very, very satisfying. The good news continues on the bottom line in terms of both operating profit as well as net profit. Operating profit for the quarter came in at 20.9%, almost 21% rounded off. That was 70 basis points better than last quarter. And for the full year, it was at 19.6%, just slightly ahead of last year, 19.6% as well, about 3 basis points higher. Net income also came in at very handsome 17% of the revenue for the quarter and 15.6% for the year. That 15.6% on the revenue of 70,000 crores is the 11,000 plus crores that I talked about. One of the greatest achievements in the last couple of quarters has been the software, HCL software or PNP as a segment. Second great quarter out in the front, selling products to thousands of customers across the globe. for the very first time over the last 3 quarters. And now it is like fully stabilized, and we are very happy to report that the investments that we made in the business are bearing the expected fruit. Uh, the the great run on this quarter's results and the full year results continues beyond the top line and the bottom line in terms of what is the most important metric for business, especially at these times, and that is the cash position and the cash generation. So very happy to report that operating cash flow at it's a $1.75 billion for the year as a whole, and as a percentage of net income, it is at 112%, which is highest amongst our peers. The balance sheet of the company continues to be very, very strong and robust. We have a gross cash position at the end of 31st March of 2 billion positive, 2032 to be precise, and a net cash position of $1.36 billion, 1359 million to be precise. We delivered a earning per share of 40.8 for the year, rupees 40.8, which was 10.8% growth on a year-on-year basis. We also publish what we call the cash EPS. Cash EPS, just as a reminder, is nothing but a number coming from the cash flow statement. It is the operating cash flow before changes in capital. Healthy 2 billion for the year, and as a cash EPS metric, which is then divided by the diluted number of shares, that came in at 52 rupees and 80 paise, 52.8. That was a healthy growth rate of 26.3% for the year. Rounding off with some more metrics to end the conversation, return on equity came in at 23.6%, and the board has recommended a final dividend of rupees 2 per share for the quarter to end the year, final dividend, which will be paid out to shareholders after the AGM. Should be happening after the AGM in September. With that, I'll hand over to Appa.
Yeah. See me.
To continue.
Sorry, due to the COVID world, I'm also having a lot of technology glitches. Bear with me, my apologies. So the whole part, I will take it in two parts. One is the people part, the other is how we are handling our people during this troubled pandemic times. We have crossed, our headcount has crossed 150,000, and we are quite happy at the growth what we are witnessing. And this includes an on-site headcount of 41,000 plus. and we started delivering from 46 countries. So that's quite significantly gone up in the last 1 year. So is the complexity of delivering from different locations, but we are doing very well on that front. Our freshers absorption has gone up by 35% compared to last year, and we hope that we will see similar numbers this year as well. So that's another thing. And the most important parameter for all of us, which is the attrition, I'm happy to report that we have brought down our attrition by 140 basis points compared to last year. And on a sequential basis, it is around 53 bps. Our localization efforts in US continues to be quite robust and strong. We are at 67.7%, which is very, very healthy. And our training efforts of upskilling, cross-skilling, multi-skilling our people have dramatically gone up. We almost have increased our training effort by 35% this year to 4.1 million hours, which is reflecting in our higher internal fulfillment parameters, which is almost 70%. So very niche skills, and for us to get skills at scale at an affordable price, our training is keeping us in good stead. And as our focus continues on gender diversity, it keeps becoming a healthy parameter for us. It has become 46.8% this year. On a sequential basis, it improved 10 basis points. And we have invested a lot of effort, time, and money in technology on HR front, which has really helped us in these troubled times. Our recruitment onboarding has become virtual globally. I mean, we have no longer we need the candidates to come physically to our premises or even to onboard them. So we are doing quite well in terms of virtually onboarding people. So these are some of the hygiene HR parameters what we have. Now coming to the COVID response, I mean, CVK has mentioned that in the month of January itself, we realized that this can create an issue for us. And we invoked our executive crisis management team. And we started doing working from home, starting from China in January and Europe in February. And by 4th March, we declared our working from home. By the time the lockdown started, we have hit 95% levels of working from home. And with the relaxations that the government has given in the past couple of weeks, we are capability-wise, we are 100% working from either home or office. The home being 96% and office or customer locations being 4%. How are we looking at our people? How are we helping them in these troubled times? So we have set up very early in January itself with the help of our sister concern, HCL Healthcare, a 24/7 global helpline, which is manned by doctors and nurses. This has given us tremendous help to our employees, because these are times where everyone, not only our employees, their families are very anxious as to the well-being of their people. And with the help of life coaches, we could provide a lot of support to our people to reduce the anxiety levels of our people. So that's one thing. And we also had life coaches who can help reduce the anxiety levels, lead our people, help them in the right direction. So that's another help. And we tied up with a few labs in terms of getting accelerated testing support if any of our employees or their family members require. And we have built a lot of policies in terms of the pandemic leave, the broadband policy for so many people working from home. In the initial days, a lot of people would face the issues with their so we worked with all our partners, and we have created a broadband policy. At the same time, we also have created a flexi policy for our employees, because in these days, a lot of people will have to take care of their children, their spouses, their elder parents or in-laws. So looking at provisions, doing household chores. So we have built a flexi policy for our people. And we have enabled video conferencing in a big way. So our teams have clocked in the month of April 100,000 plus users have used the video conferencing facility we provided, and they logged in 100 million plus hours. And we focused quite a bit on communication, a top-down communication to start with by the CEO, CFO, and CHRO. So we have had 650 sessions of leadership communication to our people, stand-up calls on a daily basis to get in and keep in touch with them. We paid our salaries a day or two earlier to our people. We have partnership with a lot of organization which we call benefits box. So, which where we work very actively with our partners in terms of getting essential supplies like medicines and provisions. When the whole online retailing has become very tight in terms of many people ordering and lack of slots, so that also has helped our people. And we are looking at the mental and well-being of our employees. And we have a constant feedback loop. I mean, we are taking feedback every time we are doing the pulse surveys from our people, and to understand what their problems are. Some people have issues related to social isolation. Some have child care. Some people have broadband issues. So we are trying to address them. And I'm glad, as CVK mentioned, our employee satisfaction levels are at around 90%. And our endeavor is to constantly keep them motivated, healthy. So that's what the brief HR update for all of you. And I will hand it over back to Neha. Over to you, Neha.
Thank you, Appa, and apologies for the glitch on the video front. We will now be opening the floor for question and answers. I would request Suraj from HCL Technologies to moderate the Q&A. Suraj, over to you.
Ladies and gentlemen, in case you want to ask a question, please click on the raise hand icon on the bottom right of the participant panel, and we will unmute your line. The first question is from the line of Swati Murthy. Ms. Murthy, please go forward. Swati, we are unable to hear you. The next question is from the line of Mr. Sriram. Mr. Sriram, please go ahead.
Hi, good morning. Thanks for the opportunity. I have two questions. One, obviously, coming from FY20, where FY20 you have done exceedingly well, strong double-digit growth and all. And CVK also have pointed out we may see near-term volatility. But overall, how do you see FY21 panning out? Like, what we hear from your peers is that the impact will be larger in Q1, and probably we may see signs of stabilization emerging from Q2 or Q3. So what's the HCL view? Like, how are you looking at the trajectory panning out in FY21?
Yeah, thank you, Sriram. So I think the commentary that you gave on the trajectory of recovery is more or less similar to our views. The impact will be more in Q1, and it will moderate in Q2, and we would see growth in H2. That's how we are looking at it. But there are many scenarios. Right now, we are assuming things are stabilizing, and you do not see any further resurgence. In that scenario, what you're saying is what will play out. So overall, when we look at FY21, we are not obviously providing any guidance from a revenue and margin perspective. We are very focused on working with our clients to see what challenges they have, how can we address them, and really be a very, very good partner for them. And we think that will, that's exactly what we're focused on in the short term. I do think that will help us in the medium and long term. And I think the best way to look at this is we are coming into this with a very, very strong performance, very strong capability. So this will hold us in good stead. Maybe there is a dip for a couple of quarters, but it's going to really be helping us come out of this very strong. I would want to leave it at that than provide any other quantitative description of how we would in FY21.
Okay. My second question is, given the circumstances, are you envisaging any change in capital allocation process or on the dividends front, like any discussion going on that front?
Why don't you take that?
Sure, CVK. So capital allocation at the moment continues to be, minimal sort of dividend of the 2 rupees per quarter per share that we have been declaring in the past as well. Remember, we doubled our number of shares at the end of December 19 when we issued a 1:1 bonus share. So we are continuing with our 2 rupees per share every quarter. And this is the time to conserve cash. So in the near term, we don't expect to see that increasing soon. We have a solid cash balance that we talked about, 2 billion plus of gross cash and 1.36 billion of net cash as well. And we will continue to see if we get some good opportunities to deploy that cash in something which is attractive.
Thank you.
The next question is from the line of Swati Murthy. Swati Murthy, please go ahead.
Hi, am I audible now?
Yes, we can hear you. Please go ahead.
Hi, this is Swati from Money Control. Just a couple of questions to Mr. Apara about the employees. So, could you tell me, what is your hiring outlook for FY21? Will there be any difference in wage hikes or promotions?
Okay. Thanks, Swati. So the hiring will definitely be lesser is what we believe at this point in time because our attrition in the month of April has significantly come down. So obviously, and with all the situation that is there, so we expect an immediate hiring in Q1 and gradually picking up. And our efficiencies in terms of internal deployment also is increasing. So overall, I do expect that our hiring levels will be a little lower. Yeah. And our annual increase cycles are in July, and possibly in the next quarterly meeting will be able to give some idea. At this point in time, we are grappling with the pandemic and we have not spent much time on that.
Okay. Sir, just a follow up. I didn't hear properly. So you said it would take a hit on hiring. In I think Q3, HCL had mentioned that you are looking to hire 15,000 freshers, 15,000 people in FY21. Does that still stand?
Yeah, it stands. It stands. The fresher hiring we are not lowering, so we are going ahead with that hiring. But lateral hiring will come down.
Could you give me some number on that, sir? How much is expected to come down?
We don't know. It is only 1 month, but this 1 month we have seen is the attrition has come down by almost 50%.
Okay.
Yeah.
And just one more last question, sir, about your gross addition had come down for Q4, about 1,000 employees. So is it because of COVID or
No, our impact of COVID on JFM quarter is negligible. So it is the general efficiencies what probably have kicked in. And lot of freshers we have taken, they also have come into picture in the last 2 quarters. So that's yeah, Vijay.
Okay. Thank you, sir.
The next question is from the line of Ms. Surbhi Agrawal. Surbhi, please go ahead.
Hi, can you hear me now? Can you hear me now?
Loud and clear. Please go ahead.
Awesome, great. So congratulations, everybody, and I hope everybody is keeping safe as well. Thank you for the great commentary and understanding and explaining the situation really well. Just a few follow-up questions. One for CVK. I know that like most of the companies, you've not given a guidance, but there are some analysts who have said that the IT services growth could drop to between 2 to 7% in the in 21 FY. So, do we expect HCL's growth to be in this range, or do you expect it to be double digits, or any indication that you can? I know it's hard, but any indication that you can provide will help us understand what's coming in the next fiscal.
Yeah, Surabhi, thanks for your question. Uh, I think we are really not in a position to provide quantitative information on the guidance for FY21. I mean, as you know, there are a lot of uncertainties. While we do know a lot of aspects with respect to our client spend, we don't know what we don't know, right? Things will play out as the next couple of months go by. So at this point, what I feel very confident is from all the client conversations, our relationships are very strong. Our propositions are very, very strong and relevant before, and it's even more relevant today. And we have invested in all the right capabilities over the last few years, which has helped us deliver an industry-leading growth for the last 4 years. And this year is really an amazing performance by HCL. So given all that, we are entering this with a strong kind of a situation, strong positioning in the market. So we will definitely gain market share in the next couple of years. I'm pretty confident. Very similar to what we have gained market share in the last 4 years. If I were to extrapolate it in the next 3 years, we would definitely gain market share and continue to deliver industry-leading growth. But that is from a 2 to 3 year perspective. I really don't want to take a punt on FY21 because there are many variables at play.
Right. Like you said that you're expecting to gain market share. So could you just explain in terms of which products or which offerings from HCL that have been built or in which the company has invested over the last couple of years will help you in these times, and which will help you actually get market share and more customers?
Multiple things to be starting from all the Mode 2 investments that we made. As I said, digitalization agenda is going to really come upon everybody much faster than what we all anticipated. So we are very well prepared to handle that. Cybersecurity, cloud adoption, Internet of Things. These are the 4 service areas where we have invested heavily. And of course, we've made massive investments in building IPs and creating IPs. And that's a business which is rock solid even in this today's environment. So we see that picking up. And in the traditional services, our engineering services, while it will see some dip in the coming quarters, but I mean, a lot of zero touch kind of customer engagement models will involve a lot of work for our engineering services. And last but not the least, the fluid workplace offering in the digital workplace business in our infrastructure service is really very, very strong momentum now. And that is something where we have a global leadership. We are rated on the top quadrant by every analyst in the world. So we are going to gain market share even from that perspective.
All right. That's it from my side. Thank you.
Next question is from the line of Ms. Rukmani Rao. Ms. Rukmani, please go ahead.
Hi, am I audible?
Yes, we can hear you. Please go ahead.
Thank you. I was wondering if you can give some bit of color on the performance of the IBM products, just a little more understanding about how they've been performing. Thank you.
So from an IBM products perspective, I mean, we consummated this acquisition by end of June last year. So now we've completed 3 quarters. Overall, the first quarter was a little bit soft, but the second quarter was very good. Third quarter has been also very good. So far we are tracking to our business case. We feel very confident of the overall outcomes of this business. And even in this situation, in the first month of this quarter, the traction for IBM products have been very strong, which are all now HCL products, whether it is digital collaboration or e-commerce or all the security products. It's been a very, very strong traction in the market. So we feel pretty good about the investments that we have made and how it will play out. Unfortunately, we are running out of time. We just have to get into another interview. So maybe we can take just one more question and close this conference.
Ladies and gentlemen, those were the only questions we had for today. Thank you. Over to you, Neha.
Thank you, Suraj, and thank you everyone for your valuable time and presence today. Please note the recording of this webcast will be available on the HCL Technologies website. With that, we conclude the press conference. Thank you once again for joining us today. Stay safe and please take care.
Thank you, everybody, for attending.